Good morning, everyone. Today we're looking at interest-only loans. So these loans, as the title says, look at a loan where only the interest is paid. So we don't pay down anything on the principal. The reason for these loans might be things like, so in this one it says they're buying some shares, you might be buying a property. And the reason you have that is often the shares or property will increase in value, allowing you to have, if Jane in this instance borrows $50,000 for shares, she might anticipate that those shares are going to raise to, who knows, $60,000 after a couple of years. So she can pay back the $50,000 but still have $10,000 left over. During that time though, the bank wants something for their trouble, so they give Jane an interest-only loan for this amount, an interest rate of 9% per annum, compounding monthly. Right, so we want to know what the monthly payment is for Jane. All right, so what she's paying is only the interest on that value. So each month she'll still have the outstanding $50,000, but it'll mean, so she's paying less off the loan than she may have to if she was going to pay off the whole amount in a normal reducing balance loan. Okay, in the hope that her shares go up in price. All right, so what we're going to use to work this out is we're just going to find the value of D, which is Jane's regular payments. D is equal to R, so the rate that Jane's paying, divided by 100 times the original. Okay. And it's important to note that R is the rate per compounding period. Okay, so if we get stuck into that, we can see that D is going to be equal to 9% divided by 12, and that's going to be all over 100 multiplied by V0, which is her initial principal, sorry. And if we work that out, we get 0.75 over 100 times 50,000. So, and if we take that and do 0.75 divided by 100 times by 50,000, we get a D value of $375. Okay, the important thing is all we need to know is what the repayments are, and they can be worked out via the rate per compounding period multiplied by over 100, multiplied by the original amount that Jane is borrowing. So at the end of the day, Jane's going to have to repay $375 each month. Okay. Short one. See you next time, gang. Thumbs up, subscribe.